Erica, thank you. A consumer price index report came out yesterday, and it caught the attention of the markets by being higher than expected. Here to talk about that report is our local financial advisor, Bruce Allen with Bruce G. Allen Investments. Thank you so much for coming in.
Good morning.
Appreciate it. All right, so describe what happened with the CPI.
Well, the inflation report came out on Tuesday, and instead of being below 6%, prices have risen over a year, 6.4%. They're down from the really significant increases in June, where prices were rising at 9%, but the markets were hoping they would come in closer to 6%, maybe even in the fives, on their way down to maybe 3 or 4. And the fact that they came in at 6.4% and both food and gasoline rose was a disappointment, and a lot of people are a little bit concerned about the fact that inflation is not coming down as fast as the Fed would like.
So not great news there, but there is some good news on the jobs front and retail sales. So talk about that portion of the economy.
Yeah, the jobs number came out. It was a knockout number that was supposed to be, it was estimated that in January we would create 188,000 new jobs. Instead, we created 517,000 jobs. I think there was an expression in Maxwell Smart and Gret Smart years ago, missed it by that much. That's a huge blowout. Yeah. And that upside surprise, along with retail sales being that robust, retail sales were up 3%. They were estimated to be up 2%. There are signs that the economy is continuing to be very strong in both the jobs market as well as the consumer remains really strong, and that has the markets concerned.
Yeah, so you have a little bit of good news there. Yes. And a little bit of bad news with the CPI. So talk about how the market's responding now.
Ultimately, all these pieces of news point to the fact that the economy remains stronger and that inflation may be staying higher than the Federal Reserve would like. And the response in the market has been, in stocks, the market's been pretty flat since the beginning of February. It's been choppy but flat, with a big response has been in the bond market. As the market's beginning to recognize that, hey, maybe the Federal Reserve needs to raise rates even higher than they have, the rates on Treasury bonds have risen. The 2-year rate's gone from 4.1% at the beginning of February to 4.6%, a full 0.5% rise. The big one, the 10-year, has gone from 3.39% to 3.8%. That's pushed mortgage prices, mortgage rates up. And so we're seeing interest rates going up as people are getting prepared for the Federal Reserve to say, hey, maybe inflation's not coming down and the economy is remaining much stronger even after all the rate hikes we did last year. So people are getting prepared for more rate hikes, perhaps even sooner than they thought.
Which is kind of a different mindset than we were thinking. We were thinking that that was going to change a little bit more, and it doesn't sound like that's the trajectory.
Yeah, the market thought, okay, one more rate hike in March, we're done. Maybe another 0.25%, we get rates up to 5%, that's going to do it, and we're going to stop. The market's beginning to start thinking that we might have another rate hike, perhaps 2 more in the summer, and so that the market's really adjusting to that, especially the bond market, as you can see. The good news is that the consumer is really strong. The jobs market's really strong. Consumer remains really strong. The bad news is that the economy is starting to tip over and start to decline in real estate and in industrial production and manufacturing. So the recession's starting to show up in certain areas of the economy, but the consumer remains really resilient. And many are afraid that the Federal Reserve will go too far to try and break the back of the consumer.
Got to find that balance.
Yes.
Thanks for keeping an eye on everything for us. Really appreciate your insight, Bruce.